Hey, happy Wednesday, everybody. Mike Tinlin here with Classic Homes. I'm the Vice President of Sales and Marketing. We want to thank you for joining us today. We're also have some guests here with us. We have Rich Liss with PenTrust. He's the Managing Director and Partner. And then we also have Stephanie Dombrowski, Senior Loan Officer with Ent Credit Union. So I think we've got, what guys, probably 65, 70 years of total real estate and industry experience here. And so we hope we bring some value to you all today. So this is our second installment of the mortgage market, or state of the mortgage market, and we will be at the conclusion of this, we'll send out next month's topic, what those dates are, and roll out a whole series for you guys. So first and foremost, let's talk about kind of why we're here. I think it's important to address, where are we at in our local market? A lot of people have questions on what's going on with housing affordability, what's going on with interest rates, where are they going, what does it mean? Should I keep renting? Should I keep buying? So our goal here is to just, provide as much education as possible. Yes, I work for Classic Homes, a local home builder. I think most of you are familiar with it. I think we have realtors and buyers and maybe prospective homeowners all that have tuned into this. Rich is obviously with PenTrust, they're one of our preferred partners. Stephanie's with Ent, one of our preferred partners. So we have biases about the market. What our intention is not to do here today is tell you, hey, you have to buy a Classic home. You have to work with us. Our goal is to really educate you on where we're at in the local market, how you can buy a home, why it's a good idea to buy a home, to build wealth for you, for your family, for the future generations, and why the longer you wait, the more it could just impair possibly you owning a home down the road. So the affordability doesn't get much better when we continue to look long term, and we're going to discuss that a little bit. So again, you don't have to buy a Classic. If you find a resale home that you're interested in, if you find another builder home that you're interested in, our message here is that if you want to own real estate, because long-term it's a great investment, you have to get in the game. And that's why we have two professionals with us here today to really instruct you on how to best do so. So Kim, why don't we go to the first slide. What we're going to do is we're going to talk a little bit about market overview. Now, if you guys can all see this slide, this is home price appreciation over the last 40 some years, okay, dating all the way back to 1976. There's a couple of highlights on here. If you look at the red circles, there are two periods in our history where our housing market took a downturn, okay, in the last 46 years. One was in 1982 when interest rates peaked at 18.5, inflation was over 10%. They dipped down quickly and then they bounced right back. The other one, we all remember the Great Recession, 2007, 2008. Obviously, a lot of delinquencies led to foreclosures. They led to short sales, overbuilt communities, a lot of inventory. Those resulted in a lot of slashing prices, bad loans made, and so we obviously saw a few years worth of negative appreciation on homes. Now, a lot of the local media is talking about where we are today. The market's going to go backwards 5%, 20%, 25%. That national level is really hard when you look at how good the job market is, our overall economy, the desire to live in Colorado Springs. It is a much different market here locally than nationally. So what we want to do is we want to kind of look at where are we at locally. Before we pass on from this slide, I do want you guys to look at, the last 2 years, you see on the far right side, those are the outliers, right? We saw 17, 18% back-to-back appreciation in our market. That's unprecedented growth. None of us are anticipating seeing that again anytime soon. But I think if we all looked at that chart, we could probably agree we're somewhere in a vicinity of 5% typical appreciation over the last 40, 45 years. So keep that 5% in mind. We're gonna actually relate to that here in a few minutes. Kim, let's move forward one if you don't mind. So this is a good look at what has real estate done over the last 10 years. Well, it's been up 115% in the last 10 years. I know, I'm sure just like everybody on this, I think Rich, myself, Stephanie, we've all had the coulda, woulda, shoulda moments. At some point or another, there's been a house or an investment opportunity, whether it was buying Apple stock 25 years ago, whether it was buying a house in a different market 4 years ago, and then you watched what it just resold for, we're all like, man, I should have made a move, right? So there you can see it's been up. The last chart obviously showed you that real estate usually doesn't go negative. And if you hold it for a period of time, it's not going to be a negative asset for you. It is going to appreciate. On our next edition of our webinar, we're going to talk a little bit more about rent rates, how those compare to housing appreciation. But back to this for now. If you look on the far right side of this, obviously that 22, 23, it says down 2.5%. but we were up almost 40% the last 2 years, hence back to the 17, 18% back-to-back years I talked about. Is it a crash, or is it a moderation, or is it an adjustment, right? Some people say, oh, prices are falling. Well, maybe they're stabilizing to where they really should have been, and the people that bought at the low side really benefited, but the rest of us are like, maybe I should buy. Maybe we need to consider that. Kim, move forward one, please, and we're gonna keep staying kind of on this conversation. So if anybody tuned in last week when we had this, we went over the same slide for January. What we're looking at here is a sheet from Pikes Peak MLS. That's the database that all of us realtors use. So some of you that are customers may or may not have seen some of this data. But when we talk about, okay, are we remoderating prices, or is it a crash? If you look at the red bubbles on this, we have new listings, 781 in February. It's down 25% compared to last February. Not necessarily a bad thing. It just means a lot of people aren't listing their houses. And I think we could probably all assert that the reason being is a lot of those are sitting in homes with 3 to 4% interest rates currently. You see where the market is today, and they're like, do I want to move into something else? Well, the pending sales, the line below that, it's not off much from last year, which means there's a lot of demand still in our market. We're off 8%, 955 sales. That's a very good trending number. That shows there's still a lot of demand. Unfortunately, there's not a whole lot of inventory to look at. Go all the way down to the bottom of that where you see active listings, 1,295 listings. Next to it, it says up 95%. Yes, it's almost 100% more listings than what we had this time last year, but those were historic lows. For us to be in a healthy, balanced market, we should have somewhere between 25 and 3,500 houses active on the market. That was kind of our going rate from 2015 and on. Now, below that, months of supply of inventory, 1.2%, or I'm sorry, 1.2 months supply. That means every 6 weeks, every 5.5 weeks, that inventory is turning, meaning the new listings that come on, they're not staying on the market for very long. So if you see something you're interested in, you should buy that. Now, spending a couple minutes with Rich and Stephanie before we started, they're still seeing some escalators on some of the deals, meaning somebody puts in an offer, there's maybe a competing offer on some of the really good houses, and they're saying, hey, we'll spend up to X and we'll spend above a competing offer up to this amount, because they don't want to miss out on what the good inventory is. So that brings back that whole question of, are we going to see price moderation or a crash? Because when you have limited inventory and you have high demand and there's not much to choose from, buyers are still getting what they're looking or what they're asking for out of their property. Hence our numbers in the blue. A couple different things to highlight here. Average sales price. So 504,000 in February. Right to the right of that, it says negative 4.2%. So I think we'd all agree we're on somewhat of a roller coaster ride here in terms of housing affordability, what prices are doing. In January, and we just did this webinar last week, we were up 4.5%. Now we're showing we're down 4.2%. So, we're gonna have to tune in and see where we're at the end of March numbers. But what's important to look at is the percentage of list price received, 98.6. We had peaked around that 103% last February, meaning all those escalators were taking place. People were spending more on the houses. They didn't want to lose them. But on a $500,000 house, that means you're getting an offer for $493. That's the going rate right now on a $500,000 house. Days on market, 54. That's a little bit closer to an equilibrium. A lot of realtors on this would agree, 40, 50, 60 days. That's not a bad thing if a house sits on the market that long. The only other thing that I want to comment on before we move forward is when we look at that average sales price of $504,000, let's just use the $500,000. And if you had that house for 5 years and it appreciated at a modest 5% per year, that house would be worth $638,000 in year 5. Okay, that's because that compounds. It's at 525 year 1. And then it's at 551 year 2, 550, 578, 607, 638,000. So part of that is if we continue to appreciate even at a smaller pace, you're building wealth, you're building that asset up. So what we're going to do is we're going to dive into some questions here. We have 4 major questions that we're going to look at. We're going to talk about rates, where they're at today, long-term kind of prognosis. We're going to talk about the recession topic. Are we in one? Are we not? Should we be in one? Should we not? We're going to talk about some mortgage programs, and then what are the top 5 tips from our professionals here today. As you are on this, please do type in. You have a chat option. Kim, who is running broadcast or production on this, is going to keep track of what those questions are. We're going to try to hold you guys to a 12:30 hard end as we promised. However, if you want us to keep going and we last another 10 to 15 minutes, we'd be happy to do a Q&A session. So let's go ahead and move forward into our questions. First one being on rates. So Rich, Stephanie, mortgage rates have more than doubled in the last year, as most of our consumers and realtors have noticed. It's hard not to with all the media headlines. What should we expect the rate environment to look like longer term?
I guess I'll jump in first, Stephanie, if that's all right.
Yes.
So yeah, rates have gone up, and you know, the numbers that you showed, Mike, that we're up almost 40% over that period of time through that COVID period. You know, part of that, and I think in large degree, were those, you know, rates that we saw in the 2% that we'd never seen in our history before. Rates as low as we had seen them, honestly, I think, barring something catastrophic happening as geopolitical or as a nation again, like a COVID situation, I don't think we'll see rates that low again. So I think as we get back to a more normalized market, thinking rates in that 5, 6, 7% are actually pretty decent when you consider what home value there is and what buying a home can do for the long term. So one thing that we've learned without a doubt over the last couple of years is inflation drives mortgage rates. If I were to loan you a $100 bill today with a 10% interest rate, let's say, the reason I would do that is in the hopes of getting $110 back later. The reason you would do it as a consumer would be to take that $100 and buy a good or service that you want today, right? That's how it works. Well, what happens with long-term rates especially is if you're paying me back a year or two or 30 years from now, if that dollar is not worth what I thought it was when I lent it to you, what's the incentive for me as a lender to lend you the money for that project? And so there's an argument to be made that people that are buying at these higher interest rates, with inflation being higher, actually coming out further ahead than you were just based on that spread between inflation and rates. But this chart kind of shows us as inflation goes up, mortgage rates go up, and we've seen that more or less going back for the next 40 or 50 years. With the exception of that period, it says QE period. So that was quantitative easing. That was during COVID. That was during a period of time when we're all locked down and the feds were pumping in, you know, billions and billions of dollars into our economy to keep it solvent. And we saw as soon as that period ends there around January of 2020, February of 2020, that's when we started seeing rates go up about a year ago.
Yeah, I think buyers are starting to settle in and realize that rates are not going to go back to the 3s and the 4s. And, you know, just starting to realize if I'm going to take advantage of the benefits of homeownership, I have to do it now and get on the bus. You know, a couple of years ago, we were giving out pre-approval letters like candy, right? Like everyone was pre-approved. And I think with the rates changing, it just makes things a little bit more consultative, I guess, when you're doing an application. It's not just here's your pre-approval and go. It's taking a look at the bigger picture. If the rates are higher now and the payments are higher, you know, what are we doing to get you into a house that you can afford, right? Is it talking about an ARM product, whether that's a short term or a long term? Is it looking at the rest of your debt and consolidating it and seeing if we can improve, you know, that payment that you want to make on the new house? Is it looking at down payment options a little bit more carefully and seeing if there's any other options out there for you? Is it just lowering the price of the house that you're looking for? So it's pre-approvals are out there and they're happening. We're just doing a lot more interviews with people and getting them into the right product that fits today's market.
That's great, and that's why we have you guys on here. Rich,
yeah,
I think
Stephanie, let me ask you a question, Stephanie. Are you seeing, I know you've been doing this a long time, people have a disconnect between what their house payment is and what their total budget is, and maybe there's a way to get their total budget in line so they can afford maybe a more expensive housing payment? Do you see that? I see that consistently with customers, that they try to bucket their lives.
Yes, and we talked about that earlier. Sometimes, you know, I'm looking at a car payment that's pretty close to $1,000, right? And we're talking about a $2,500 mortgage payment. And connecting those together and looking at, okay, well, what if I could throw in a couple of credit cards and refinance your auto loan, and if your total payments are still this amount, would you feel comfortable if your home payment was $2,500? So it's conversations that we, had way back in the past. We haven't had them for a couple of years, but now they're coming back again, and realizing it's not just the housing payment, it's your total monthly debt.
So I guess a good piece of advice for everybody is, you can download that Zillow app, you can plug in a payment, but there's a lot more to qualifying yourself than just typing up on a mortgage calculator and saying, oh, geez. Get with an expert, get with Rich, get with Stephanie. If you have a long-term relationship with somebody, then get with them. But look at the whole picture, right? Is that a correct assessment from both of you guys? It's like,
Absolutely.
give us an opportunity to see every obligation financially and how those might be adjusted to make sure that the house fits into your budget. The other thing I just want to add in before we move to question 2, and if you guys have any comments on it, great, please add to this. But saw an article 2 weeks ago that the average interest rate on mortgages since 1971 was 7.5%. So obviously we talked about, in the 80s, we saw it as high as 18.5. And we fast forward to 2019, 2020, we saw it as low as 2.75, probably even lower some of the VA. As things get a little bit more in balance, right? Hopefully, like amount of inventory, days on market, months of supply, it almost seems like as if rates are getting a little bit more of a normative balance of a historical average. You guys have any comments or anything to add to that?
I think you're absolutely right. I mean, the data speaks for itself. I think the problem that we have right now, Mike, is that we've become both psychologically and physically attached to low interest rates in every part of our life, whether it's your car payments or your student loans or your housing, whatever it is. And so as we move to a different era, right, we have to, we look back and say that was great, but that's just not the reality of what's going to be moving forward, I don't think. And so we're going to have to do things a little bit differently and start to mentally wrap our minds around how do we negotiate our debt in such a way that we can still afford it. And at the end of the day, I know at least those of us on the call believe that's owning a home is the only way for a regular middle-class American to get ahead.
Yeah, good call. All right, let's move on to question 2, Kim. So we're looking at recession topic here. Some say we're headed for a recession, others say we're already in one. What do you think, and what does it mean to the housing/lending industry? So Stephanie, you want to hit this one first?
Sure. I think that you said it earlier. Our local economy is a lot different than when you're looking at the average. Our job market here is very strong. There are people moving here from all states, want to land in Colorado. If the inventory is low, the demand is there. We're getting pre-approvals every single day. If we go into a recession, I don't know. I think the rates may change, housing may change. I guess I kind of feel like no matter what anyone's predicting, we have to live where we're living right now. What's happening with the market right now? What's happening with the rates right now? Colorado Springs has been always strong. Even, when I think about 2008 was the last time that we felt some differences. Colorado Springs was still strong during that time. And I think we're going to continue to be. So if the demand for housing is here in our market and we have houses available for them and we have lending products that fit their needs, I think that's what we should concentrate on. Get these folks in housing. People want to buy, realtors want to sell, home builders want to sell, and we've got all the products for them. So let's, live where we're at today.
I like it. Buy the home you fall in love with. Rich, what do you have to say about that?
Well, I think she's absolutely correct. And I think if we look back, and I don't think we put the slide up for this, but if we look back at the last 10 recessions that we've had, I personally believe that we're probably already in some type of recession. That a lot of the data leads to that. Other data still be really strong. But to Stephanie's point, Colorado Springs has consistently been somewhat immune to that. But if we look at it on a whole, over the past 10 recessions that we've had, with the exception of the 2008 housing crisis, real estate performed exceptionally well in 9 out of 10 of the last times had a recession. I think the media throws around recession really to kind of scare us, and it does scare us. We hear that word and we think, we're going to lose our jobs, or we're not going to be able to go out either, or whatever. And that's simply not the case in most cases. So yes, I think as we start to see the market a little bit, we'll probably see interest rates start to improve. But to Stephanie's point, if you wait till that happens, it's probably going to be too late. There's already, to the data that you showed, only 12 or 100 homes available in our market. And if rates drop a little, the demand is going to be so strong that we're going to, we could be back in the same situation we were years ago.
Yeah, that's a great point. One thing that we really haven't talked about was that topic that Rich just touched on is, if we go into recession and they bring inflation down and then rates dive down and we don't get a huge influx of houses on the market, which, Rich shared a great CNN Money article today that we're 6.5 million homes underbuilt in America right now. We know we're locally built with some of the big companies that have made announcements moving in here. And so unless we get a huge infusion of houses that hit the market or a ton of builder inventory, the few houses that are on the market, if interest rates dip down, what do we all think is going to happen to those prices? They're not going to go down. They're going to go this way, right? Supply and demand. I mean, economics 101. So great point.
Well, that's what this is what this slide shows right here, Mike. It shows exactly what you're talking about in that article that was put out by CNN. This shows housing formations that have been formed over the past couple years. What we generally see in America, if we look back over the last handful of years, there's somewhere between 1.7 and 1.9 million new households. What's happened recently is we look at where this slide takes us to the end of last year. That number was substantially down because of just the fear of recession, the fear of interest rates, the fear of not moving out of mom and dad's basement to create my own household formations. So to your point, we're already behind the curve with housing units, especially locally, nationally. Well, but when this number starts to rebound, folks can only stay in mom's basement for so long before they have to get out. And that's what this graph shows us, is that a normal market is somewhere around 1.7, 1.8. At the moment, we're around 1.2 or 1.3, and so the demand is building the housing units that we have, and we know that there's no one producing.
Yeah, great slide, great visual. Let's get into, how do we get people into different homes? So specifically on the topic of mortgage programs, what are some of the new programs available that can help people lower their monthly payments? Rich, let's tee this one up on your side first.
Sure. So the biggest thing that we've been having a lot of success with over the last 12 months at PenTrust is with 2 and 3/1 buy downs. So essentially how that works is, let's say the rate today is 6% for the sake of argument. You can have a tiered interest rate that's still a fixed interest rate that starts as low as maybe 3%. So 3% for the first year, 4% for the second year, 5% for the third year, and 6% for the life of the loan. This gives you the ability to kind of tier into your mortgage payment while still knowing that you have a fixed rate mortgage. The other benefit to this, and why we like it so much and why we think now is a good time to buy, is builders like yourself are offering incentives to home buyers to pay for these types of things. And the great thing about those 2 or 3/1 buy downs is, if I refinance or have to sell my home 1 or 2 years in, I receive that money back that I prepaid towards that. So there's nothing lost. If I buy a house today, I keep talking to buyers saying, hey, we'll wait till next year, we'll wait till interest rates come down. I think number one, we've demonstrated that you just might not be in a great position to do that if you wait. And the other side of the coin is, by buying now, getting the house that you want, you can probably have the payment that you need to have, and then refinance 6, 12, or 18 months when most experts are interest rates to come back down.
And that's a meaningful savings. I mean, that year one payment, when you're looking at going from a 6% to a 3% or whatever kind of program you qualify to, I mean, that is a significant reduction on your principal interest in that first year. Right. All right, Stephanie, how about new programs over at ENT that you'd like to share with the group?
What has been a lot more popular the last year really has been the longer term ARMs. So for instance, we've got 5-year ARMs, so that would mean the first 5 years are fixed. And then after the 5 years, that's when the payments and the rates can start adjusting. So our 5-year ARM right now is almost a point lower than the fixed rate. So same type of thing that Rich was talking about. So I know for the first 5 years, I'm going to have this lower payment. You know, we did in a couple of examples. It depends, of course, on the loan amount, but it can save $300-400 a month over a fixed rate. So if you were thinking today's rates are higher, you're probably going to refinance in the next couple of years, at least you know for the first 5 years, your rate can be this and your rate can be lower. And of course, any lender can help you figure out during those 5 years when is the best time to refinance, and you can always check in back with us. But that's been very strong. First-time home buyers, we've been offering a lower rate than if you weren't a first-time home buyer, and the first-time home buyers only means that you haven't owned a home in the last 3 years. So a lot of people have been taking advantage of that and lower down payments for those at 3%.
That's really nice. I mean, we got a lot of people that stay in homes for 5, 6, 7 years, and then they start shopping again. So hopefully you guys heard that
Right.
point, that, you know, if it's been longer than 3 years, you're considered a first-time home buyer again. And then you use the key word that I'm sure some people heard, the word refinance, which we like to kind of throw around that coin term, date the rate and marry the house, right? We talked about that the other week. Is, you know, with a limited amount of inventory and the amount of demand in our marketplace, you should, if you find a house that you love, you should marry it. And then to Stephanie's point, Rich's point, with the, you know, there's different programs that these guys are up to speed on all the time, and it's ever changing. That whole climate, you know, they're trying to get creative and roll new stuff out. Date the rate, date your loan program. You can always refinance when they come out with new stuff. And trust me, you know, nationally, I mean, this has caught the attention of everyone. When you look back at our initial chart on affordability in the housing industry, it's done this nonstop, right? Rates are up, rates are down, rates are up, rates are down, prices are up, prices are down. Inventory is up, inventory is down. Well, they're trying to find good solutions for you, the consumer. So make sure you keep, you know, in contact with these guys and what kind of programs are rolling out. But when you find the house, act on the house if you can afford it, and then figure out your longer term financing. It doesn't have to be in the first program you get yourself into. All right, we got 3 minutes and then we'll dive into questions. We got one more on our topic of the tips that come directly from our experts, the top 5. What are the top 5 mortgage and financing tips for people who are in either the process of building a new home or considering purchasing an existing one?
So I think first and foremost, this sounds really basic, Mike, but be transparent and be honest. When you call a mortgage lender, their job is to get you a mortgage, and so they really want to. Their intention is not to decline you. Our intention is to approve you. And so it's so helpful if we can know early on where are the pitfalls, where's maybe the pothole that you might have. Share that with your loan originator up front, and let us help you navigate around it. So just be truthful, be honest, and be transparent, number one.
All right, love it.
You know, before you meet with us, you know, grab all the documents that you think we may need. It may be less than what you think or more than what you think, but obviously your income documents, any assets that you have, which would be bank statements that your savings and checking are in, or any 401k retirement funds that you have. Gather those or be able to find out where to get them. Think about your down payment sources. What you have available. We'll also explore with you other options you haven't thought about. You know, your employment status, you know, we'll help you figure out, you know, if you're part-time, if we can use it, if you're self-employed, if we can use it, all that documentation, get it to us as fast as you can. The one thing that we always say is when we take your application, it's kind of like taking a picture at that moment, right? We've got a picture of your credit, we've got a picture of your income, all your debts. If anything changes from that picture that we took when we first met you, let us know. You know, did you buy something new? Are you thinking about opening a credit card? Are you thinking about co-signing with somebody? You're getting a large deposit. Any of those things that changes the picture that we took when we first met with you could change your mortgage approval. So it's always best to talk with your loan officer before you make any major decisions, and so that picture stays the same until closing, basically.
Great input, you guys. These seem like basics for us, right? We've been in this industry for each over 20 years, so it seems pretty elementary, but I think we have a lot of people that those basics can help them avoid pitfalls through the purchase experience. So thanks for sharing. So we are at 12:30. We are right on time. Again, we committed that we'd love to stay longer. Kim, do we have any questions that we have the opportunity to address?
Yes, Mike, we have 2 questions at the moment. The first question is, what is the difference between being pre-qualified and being pre-approved?
Yeah, great question. Who wants to take that?
I'll take it. Typically when you're pre-qualified, it's just really a conversation that you have with a loan officer. This is how much I make. These are the debts. When we ask about debt, it's things that you would see on the credit report, right? Auto loans, credit cards, student loans. So we would take a look at that picture and kind of give you an idea based on the rates and your down payment of how much you can afford. When you're pre-approved, I've looked at your credit and verified all the debts that you have, and then you have sent me your income docs. So not only have you, told me I make this much, but I'm actually looking at your pay stub, figuring out exactly what your monthly income is, whether we can include bonuses or not, and all of that. So when you have a pre-approval, you really should be ready to go, ready to buy.
Thanks, Stephanie. All right, Kim, next question.
Yep, next question is, I am considering purchasing my first home. How much on average should I be saving for my down payment?
Yeah, that's a good question. Answer is it probably depends, right, Rich?
Yeah, absolutely. It absolutely depends. There's conventional loan products with 3% down right now. There's first-time homebuyer products with little to no money down. If you're a veteran, of course, no money requirement down. So really, my recommendation is there's not a one-size-fits-all. The best mortgage terms generally apply at 5 or 10% down. So that's just kind of a good rule of thumb, assuming you're not a veteran. But there might be a scenario where you could get down with just a couple out of pocket.
Great answer.
And then we've got one more, and this question is, how does a mortgage buy down work, and how does it affect the customer versus the seller?
Rich, I'll let you take that one as well on the buy down.
Yeah. So there's two types of buy downs. There's the permanent buy down that we're all relatively familiar with, where if the interest rate is 6, you pay an upfront fee and you buy it down to 5.5. The 2-1 buy down or the 3-2-1 buy down is a little bit different, and the money comes from the seller. It gets essentially held in an escrow account for you. It gets held in a little bucket that's set aside for you. You'll actually draw from those seller funds monthly, and every month it will be contributed toward your mortgage on your behalf. So it affects the seller, it does not affect the buyer. The great thing as well is if you did a 2-1 buy down, for example, and you took that savings over those first 2 years, if you were to refinance 6 or 12 months in, you would receive the money back that you had used. So the cost in those is to the seller, not to the buyer, and is equal to the amount of the savings. So there's no fees, there's no add-ons. It's simply the amount of principal and interest, or the interest that you're saving, is how much it costs the seller.
Great. Rich, do you want to share, is there a typical, if somebody was going into a resale transaction, right? And we share that information that most of the transactions are going for 98.6% of list price. So I'll use round numbers. If you have a $100,000 house, most of those houses are selling for $98,600. What percentage of that purchase price is a typical buy down going to cost a seller?
Yeah, so typically on the 2-1 buy down, which is the most popular, on an average house in the Springs, you're going to save about $600 a month in your first year. So the cost of that buy down equates to about 2% of the sales price, generally speaking. The 3-2-1 buy down comes with additional savings to the buyer, and the cost about doubles to roughly 4% of the purchase price.
Okay, so you broke up just a little bit. You were saying the 2-1 is about 2%, and then the 3-2-1 is about 4%, right, of the purchase price?
Exactly.
Okay, thanks for clarifying that. Good questions, great answers. Kim, do we have any more that got typed in the last minute or two?
We do not, Mike. That was
Okay.
it for the questions.
Wonderful. Well, we really want to thank you guys for joining us today. Hopefully you found some value in this. Kim will be sending out a evaluation to you following this, and we would love to hear from you. We'd love your feedback. You know, if there's some content that you'd like to have us add into the next webinar, or something specific that you're really wishing we would cover and focus on more intently, please do share that with us. We want your feedback. We will plan on being back on, I believe, the second Wednesday of next month, so be on the lookout for a new invite that comes out here in the next few days or week. But again, so from all of us, Rich, thank you for being on. Stephanie, thank you as well. You guys' expertise is always well appointed and incredible. So appreciate your participation today. And thank you to all the prospects, buyers, realtors that joined us today. And we look forward to seeing you on the next webinar. All right, take care, everybody.